Well, good morning, everyone. Thanks again for joining us on our quarterly investment call for clients. I'm delighted to say we've got another excellent guest speaker joining us today to share their views on the markets and the global economy as we draw towards the end of what's been probably an exceedingly challenging and volatile year, I think we can describe it as. The year's been dominated by two major and somewhat intertwined macro factors: the war in Ukraine and inflation. We've seen significant volatility in all asset markets this year, including the often calmer backwaters of global bond markets. Indeed, bond markets have probably never been more in the news than they were at the back end of September, during the extremes of volatility we saw in the wake of the ill-fated mini-budget here in the UK. I'm therefore delighted today that we're joined by Matthew Morgan from Jupiter Asset Management. Matthew is the head of fixed income at Jupiter. He's responsible for the oversight and management of all of Jupiter's fixed income team, and therefore he's extremely well placed to talk to us about the macroeconomic conditions that have been driving markets this year, and to share Jupiter's outlook for the economy and how they see this playing out in bond markets. As always, we will try and allow some time for questions at the end of the call. Please, can you submit these online as we go using the Zoom Q&A function? And we'll try and pick these up at the end of the presentation if we've got time. Before I hand over to Matthew, I thought I'd just share this slide showing the performance of many of the major markets this year in their local currency terms. What's clear is that the majority of indices have had a very challenging year, posting significant negative returns so far, despite the relief rally that we've seen in recent weeks. This sort of negative return profile applies to both global equity and bond indices. For example, if we can pick it out on the chart, the broad UK government bond index has returned around minus 21% so far this year, although this was actually as low as minus 30% at the end of September. There are a couple of outliers on the chart that are in positive territory and just worth commenting on. The first is the blue line, the FTSE 100. Which is a bit of an anomaly compared to other global markets, due principally to its weighting towards certain sectors, namely things like energy and banks, and also because of the weakness of sterling this year, given that the majority of earnings from the UK's biggest 100 companies are generated overseas principally. The black line on the chart is UK price inflation, up over 12% so far this year, and one of the principal causes of most of this year's market woes. So with the outlook for inflation and the overall global economy at the foremost of everyone's thoughts at present, I think probably it's time, if I could hand over to Matthew, I'll let him share his own thoughts on that for us all to enjoy.
Thank you very much, Henry, and thank you very much to all of you for listening and to having me today. It's a fantastic opportunity to talk to you about fixed income, which often is the part of your portfolio that you forget about, or perhaps, in the case of a COVID crisis, you're happy it's there. This has been a year that, in some ways, I'd like to forget, but actually a year that we've certainly taken a lot of learning away from. It's been incredibly challenging. We have not seen, it depends on the market, the metrics you look at, but we haven't seen years where both, if you think of fixed income as a combination of that interest rate exposure and then your risk exposure in the form of, your corporate bond spread, and normally those diversify each other as fixed income diversifies with equities. We haven't had a year like this, by some measures to the 80s, to some measures to the 30s, some measures ever. So it's been incredibly challenging for all of us, but fascinating nonetheless. I guess the good thing is that this time last year, I would be talking to you about fixed income where, big clients were saying to me, what do you think we can make from credit markets on next year? And obviously, the best answer you can really come up with is, well, I hope that rates stay where they are and you get to keep your coupon because everything looks so tight. Now you're in a position where some pretty high quality assets with very low default risk are yielding very interesting numbers. The income is back in income. And that means that looking forward, particularly if we're right on our macro view, you have a really quite interesting opportunity to access the asset class. But let's focus, if we go on to that first slide, I'll give a quick resume of our macro view. And then I'll go through some slides that I hope are interesting, and please do feel free to ask questions. It will be a little bit global centric because we tend to think globally. I'll try to cover the UK, but very happy to take questions on the UK as we go through. But look, so if I try and set a bit of backdrop, we have been, many of us who know our desk know that we think very long term. We tend to think 12 to 36 months in markets. We're really trying to think, what's the next structural shift in markets and how do we make money for our investors from that? And our view coming into this year was that there was going to be a risk of higher rates as central banks look to try to get out of the kind of incredibly easy monetary policy that we had through the COVID era. And that meant that we did reduce duration, that sensitivity to interest rates at the end of last year. But what our view for this year, Q1 was relatively contrarian. We were saying that, look, inflation isn't here structurally. It's not going to last forever. We still don't have a world of huge amounts of growth and productivity. We're still living in a world where demographics make high levels of growth difficult just because the amount that the world spends on productive stuff is so much lower. That dwarfs any other impacts of demographics on the workforce. We still have a world that's got $300 trillion worth of debt. It's only been added to. And these central banks are going to keep tightening, and inflation won't last, and it's going to cause a very deep recession. That was contrarian view in Q1. Sorry, for some reason, this camera keeps on moving in and out. I'm not controlling it. We just have to get used to it because I have no idea how to stop it. This growth is not going to sustain inflation, and the only way that central banks are going to kill inflation is going to cause a huge recession. And that will eventually see us with much lower yields. That caused us to start buying government bonds again a little too early. We didn't predict that the war in Ukraine would cause such high levels of inflation through food and energy. But it's actually over the year, that view is just calcified, and it's becoming more and more consensus. And right now, I think the balance of views in markets is, inflation is starting to roll over, but not quickly enough for central banks. They're going to keep doing all this tightening. That's going to cause the probability of a soft landing, as we call it, is significantly reduced. Our view is it's impossible to have a soft landing. Our view is we are going to see central banks overcook it, cause recession, which will bring down inflation significantly and lead to a much lower yield environment. It's not a positive picture. I don't think the UK in any way escapes from that, even though we are seeing some better news on inflation globally. Central banks have got the bit between their teeth and are going to make life difficult for us all for some time. So let me go through all that view in detail. That was sort of a summary. If we go on to the next slide, please, Henry. I think I just want to make the point on this slide. There's many ways I could do this. Many of you that know our team know that we have a macro deck of about 100 slides. And that's, I picked up what I think are the best ones. What we've seen this year is the fastest pace of tightening that we have ever seen, give or take. Now, what do I mean by tightening? I mean, the Fed has raised interest rates faster than ever. That's not just the Fed. Globally, since the start of 2021, we have seen through over 330, and that data is about a month out of date. I should get it updated soon, so it's probably nearer 350 interest rate hikes globally. The tightening after COVID has been sharp and aggressive. We are also seeing central banks start to taper. The UK starting to sell its bond holdings. The US has doubled the pace of tapering. And by tapering, I mean all of that extraordinary buying of bonds they did to keep the markets afloat through COVID. So they're doing that. You also have a dollar that, despite marginal weakening in recent weeks, has had an enormous move upwards over this year. And the dollar, as the world's funding currency, particularly in emerging markets, but particularly for most countries have to buy their oil in dollars and they don't make money in dollars, that has a massive tightening effect on global liquidity. And you're starting to see that. And I've picked here US money supply growth. And I don't want to go into the arcaneness of money supply and economics, but the supply of money, the bottom chart shows that it's contracting at a rate that we haven't seen since the 1930s. This is really telling you liquidity is coming out of the economy. And this has only just started. The most important thing to remember about interest rate hikes is they operate with what the Fed has always called long and variable lags, meaning 12 to 18 months it takes for a interest rate to have an effect on the economy. And the Fed has done 300 basis points in a very short space of time. And what's happening, and the image I like to use, is the Fed is watering its garden, and it's turning the hose on and the water's not coming out. And it keeps on turning the hose. And what it's causing is a flood that is in the hose and it can't turn off. And so what we are seeing now in money supply declining, in some of those economic growth figures starting to roll over, is really just the start. And the key is that we think that the Fed is going to keep going and really going to overcook it. And that's having an impact on global growth already. If we turn to the next slide, you can see what's happening in manufacturing. One of the things that I really want to be clear about with clients is that the Fed's in a difficult space because the Fed is trying to steer this oil tanker of an economy. When I say the Fed, it's a shorthand for all central banks, but the Fed is the one we focus on the most as the world central banks. And it's sailing forward, but it's worried about inflation, but everything it looks at to steer that economy is old data. So it principally looks at inflation, which tells you what inflation was like months ago. And it principally looks at employment, which tells you about hiring decisions made several months ago. When we look forward to stuff that's more fast moving, we can see clearly that the economy is slowing fast. This is global data, by the way. And what it shows you is PMIs, which are manufacturing indices, manufacturing surveys. And it's about new orders. Why do we use new orders? Because new orders tend to lead the broader PMIs, because it's about, how much demand people are seeing for their goods. And you have seen that plummet from very significantly. And what this chart shows is that 75% of countries across the world have their manufacturing new orders in under 50. Under 50 means it's going backwards. It's recessionary. So that's telling you that manufacturing is starting to slow very quickly. And on the next slide, you can see that that's having a direct impact on the confidence of people who run companies. This is the Conference Board survey of CEOs in the US, and this tends to lead CapEx, by which I mean, this is the confidence of the people who are making spending decisions on capital expenditure, but also things like employment decisions over the next 6 months. And while the employment data right now in the US looks pretty strong, that is backward looking. A lot of it's based on people struggling to make ends meet with the cost of living crisis, doing 2 jobs. We start to see forward-looking indications of growth and employment looking worse and worse. So what we are seeing globally is forward-looking growth indicators, and there are many we could talk about. Consumer sentiment is a big part of this, really starting to fall over in the face of higher inflation, higher interest rates, etc. And a lot of that, if we move on to the next slide, is having a direct impact on housing. Now, housing is the world's biggest asset class, and it has 2 really big impacts on the global economy. The first is particularly in the US, the construction industry, that is around 25% of US GDP. The second is on consumer confidence, because if people feel house prices are falling, it has a big impact on confidence. The third is mortgage interest rates, particularly in places like the UK and Australia, where those mortgage interest rates tend to be reset pretty quickly and have a direct impact. I'm sure many of you I'm speaking to are having to remortgage even now at levels you didn't think possible a couple of years ago. And then finally, it's a very, very important part of inflation. And what we can see here is what's happening on savings rates and credit. So already people in their cost, as mortgage rates are going up, as the cost of living worsens, is that savings are being drawn down and credit is starting to be used. So a lot of the growth we've seen in recent months and weeks has been driven by credit, and that is starting to become exhausted. The next slide shows you how home affordability has collapsed. This is going to be similar in the UK, Australia, everywhere, that people are not going to be willing to buy homes at mortgage rates that they are seeing now. Affordability has collapsed. Affordability is also driven by higher prices. We've seen a boom, particularly in the US. But you can see how quickly housing affordability has fallen from in the last few weeks and months. We can expect to see that continue to decline. This has a huge impact, firstly, on the US economy, because the US has an economy that is 25% construction and housing. And that is something that, as I'll show in a couple of slides, will lead to lower growth. The next slide shows you what's happening to house prices. Why is this important? Well, firstly, as a direct impact on consumer confidence, thanks to wealth destruction. But the second thing is that housing is a very important part of inflation. Housing contributes about 30% of US CPI. It's the actual inflation component of US CPI it's interesting. It's a number that is backed out of house prices, very inaccurate, and it's also smooth, which tells you that when we saw that huge boom in house prices that you can see on the right of this chart when the line was going up, then actually US inflation didn't fully reflect house prices. But what that means is when house prices start to fall, it takes a long time for those house price falls to come into inflation. And what we saw last week with the US CPI miss was the first signs that that shelter inflation is really starting to reduce inflation. The other thing is that you can see on the next slide a clear relationship between housing sentiment from home builders and unemployment. It's often said, it's a cliche, but it has a lot of validity, that where the US housing goes, the global economy goes. Just to explain this chart, because to make it work, it's slightly confusing. The black line is the National Association of Home Builders Index, which is basically house builder confidence in the US. And we've inverted it to make it make sense for the unemployment rate, which means that as this line goes up, that the sentiment in house building has deteriorated significantly. And as you can see in the past, when we have often seen, of course, COVID was an unusual period, that line go up, it has often usually been followed by a significant deterioration in the US economy. And we think that this is a very good leading indicator of the fact that we should start to see unemployment start to rise. And on the next slide, you can already see that that is starting to happen. This shows the job openings in the US in the black line, and then we have wage growth. And the Atlanta Fed, just to explain, they do some pretty fast moving, pretty volatile, and you have to take them with a little bit of pinch of salt because it tends to be leading rather than backward looking. The Fed is looking at wages, looking backwards. The Atlanta Fed does some faster moving signals, and you can show that some of that employment, which has been very, very strong since the COVID period, is starting to peak quite significantly. And that's telling us two things: that growth is starting to fade quite quickly, and secondly, that inflation is starting to fade. And the good news for the global economy, US, but also true in the UK, is that there's a lot of reasons to believe that inflation is peaking and starting to come down. If we look at the next slide, we can see how much commodities have come down from that peak. And this is something that really started in the summer. But of course, it takes some time to come through, because companies that build the stuff that we are buying for our, all the huge amount of plastic nonsense that I'm sure people and I will be buying for my children at Christmas, the stuff that goes into the manufacture of that is bought, was bought 6 months to a year ago. So it takes time for them to feed through to prices. But you can see there's a clear downward trajectory on inflation from commodities. And on the next slide, you can see the same from food. And this is really important, because when you look at that, when you look at all the press coverage we saw yesterday of food prices driving inflation up to 11% in the UK, which is, a UK problem. It's worse than France and Germany, but the last print for the Netherlands was 14. You can see that actually that food inflation has really fallen hugely. And that gives us fairly decent degree of confidence that even the permanently bearish Andrew Bailey yesterday was willing to say that inflation is probably peaking in food, but gives us a feeling that inflation is starting to fall. So let me just pause and summarize what I've said so far. We have seen a huge rises in inflation over the last 12 months or so, from very low levels. It's amazing when you think of what central bankers were saying. It was only a little more than 12 months ago that, I can't remember if it was one of the Fed guys or Christine Lagarde, I should check, said that the great problem of central banking of our era is the lack of inflation. And look where we are now. Inflation has skyrocketed, driven mostly by a war, in part by COVID and people leaving the workforce, etc. The thing is, that's really coming down. And that's being driven. I've mentioned commodities and food, but if we look at, we mentioned shelter, if we look at used cars in the US, they've really fallen. If you look at shipping rates, if you look at freight, and many other indicators that I will remember as soon as the call finishes, you're seeing inflation fall, or at least peak, and that will continue. At the same time, you're starting to see growth deteriorate. Where does this roll on from here? Well, the key thing is that if you think back to those comments I made about all the tightening that we expect to see in we have seen in markets, and the fact that it hasn't fed through to the economies yet, we think growth is going to deteriorate significantly, and we are just at the start. We are going to be setting for a hard landing over the next 6 to 12 months. That is going to lead to a change in central bank policy eventually. Many people say, okay, but inflation is still elevated. Will it go back to the levels before? Well, right now, I can tell you inflation's peaked and it's heading down, but it's still at high levels. The thing that's most important, going on the next slide, is that you cannot have inflation without growth. I know the chart's a bit hard to read, but just to make it really simple, over the last 100 years, on average, a recession in the US has caused a drop of inflation from the high to the low of 7%. If we were talking at this time in 2008, we would have inflation that was still around 5-6%. By Easter 2009, we had inflation at -2%. Inflation is persistently killed by recessions. And that's something that, is part of our business case, our base case to clients, that as the economy slows, as that tapering comes through, as the Fed continues to, having got inflation wrong, overcook it and overkill the economy, you will see recession, and that will kill inflation. And that will mean a big drop in yields. There are clients that say with good reason, but this is different. Okay, inflation falls in the recession, but it comes back. We disagree. And that goes back to my comments at the start about demographics. A lot of comparisons are made now about the 70s. If we move on to the next slide. The thing I would say about the 70s is that even in the 70s, you saw massive drops in inflation when recessions happened, around the time of the energy crises, and then again, the kind of self-inflicted recession of the 1980s. But this is, that was a central bank policy tightening. But this was a completely different era. Firstly, you had central bankers that pursued different policies. Jerome Powell keeps telling us he wants to be, the reincarnation of Paul Volcker, who induced the recession on the right-hand side by raising interest rates to 20%, and not make the mistakes of Arthur Burns, who let policy too loose. So as soon as these recessions finished, inflation started to jump again. But this is a completely different era demographically. In the 60s, from late 60s through to the late 80s, early 90s, you had the baby boomers come online. You saw this massive increase in population from the post-war era, people who were buying houses in the suburbs, buying white goods, causing huge demand that the global industry just couldn't cope with. Today, demographics is different. We have, it's not just, it's obviously, the story of Japan. South Korea has the worst birth to death rate in globally. China is predicted to have its population halved in the next 100 years. Demographics look terrible. Europe is similar. Even the US is sustaining its growth only through immigration. And that is having political consequences. And what this means for us is that once we get through this recession kills inflation, we will go back to the last 10 years of having growth anemic, 3% global growth, 1% if we're lucky in Europe, and in the UK, 2% in the US. And that will keep inflation back down to levels that we haven't seen before. And that obviously is very supportive for reallocating to fixed income, because we would expect that as this happens, you will start to see interest rates fall materially to cope with that adjusted reality of low growth and low inflation. We can easily see, say, the US 10-year fall 200 basis points. That's our base case. The question clients ask is, when does it happen? And we've always been open that we don't know how to time markets. Our job is to pick the next inflection point and position in a way that can make the highest risk-adjusted returns. What I would say is, given the Fed is tightening, we are seeing stress in the global economy. We are seeing a worrying decline in housing. We are worried about the Chinese economy. We are seeing liquidity dry up in pockets of the market. Look, for what it's worth, I don't in any way justify the policy of Truss and Kwarteng. It was at best misguided and ill-timed. But if you look at the market reaction, it was extreme. Similarly to Credit Suisse, when we have a bank that was again unprofitable. We know it's badly run, and is likely to have a capital raise. Its bonds started trading at default levels. This is telling you that we are reaching periods with all this tightening that the market, there could be something that breaks. I don't think we'll see a financial sector. We really like financials there because banks are completely different animals to where they were 10 years ago. But we do think that over the next 6 to 12 months, perhaps even shorter, the risk of systemic liquidity issues in global markets is increasing. But as we look forward, the positive news for fixed income investors is that we have pretty high conviction. If we look at the next slide, that when we look particularly at the sort of safer ends of high yield or the cheaper end of investment grade, you're starting to see valuations that are very interesting. And just to give you an example to finish on as I run out of time, right now you're getting European telecommunications companies, and telecoms these days and we see them as utilities. Even in the worst of times, people keep their mobile phone contract. You've got bonds that are secured on hard cable assets that are core to the economic infrastructure, and they're trading at nearly 10%. And that is something that is extremely interesting. And yes, I know I'm saying a recession's coming and you may continue to see volatility in fixed income, but right now with the yields you're getting, you're paid to wait. And that's what makes it interesting. Henry, I hope I haven't gone on too long there, and I've left some time for questions. I'd love to take anything anyone wants to throw at me.
Yeah, absolutely. Thank you, Matthew. Yeah, I had a question to start actually, which might sort of tie into some of the things you've been saying. Obviously, talk of recession, inevitable recession, and as you've laid it out, it obviously is disconcerting for clients. Clients, I guess, who have seen returns this year from most asset classes be really quite challenging. Equities and bonds, there really haven't been much in the way of diversification benefits this year. I think what you're saying is, looking forward, then we might start to see some better benefits coming through from those diversifications, sort of in the short term and significantly in the longer term. I guess not sort of asking you to sort of, you say, sort of time markets, but would you like to maybe elaborate on that point a little bit about how you see bonds, the role they play, in sort of a tougher period, with and sort of how their return profile may sort of align with different parts of the portfolios for a traditional sort of diversified client?
Yeah, sure. So it's a great question, and one I will try to answer quickly. And as Harriet, sales colleague here, knows, I tend to answer too long, and this is something we could spend an hour on. So trying to sort of break down your question, look, if we think about the short term, I know it's been a horrible year. One thing I would argue with, you look at fixed income, and this is something, well, if you look at multi-asset, if you like, and this is something you shouldn't write down because I'm not an equity person, but we definitely would say that when you're getting yields of, strategies with yields of nearly 7% for an investment grade risk, you look at the way that fixed income is priced right now, because you've seen that selling off in interest rates, you've seen people dumping bonds, you've seen people worried about central bank tapering. When you look at a 4% yield on the US 10-year, for example, that just looks incredibly good value compared to an S&P that's trading not far off 4,000. So I would definitely, and don't write down any comments I make about equity, say that it looks like the pricing of recession has hit certain parts of the fixed income market, and we're not there in equities. I guess on a more positive note, while we do think you will see volatility as that recessions get priced, I think you will see another period of fear grip markets. You will see wider spreads. You will see equity markets sell off. But the two things is that, firstly, you are getting paid to wait in fixed income. That means that if you are taking those yields, you can tolerate, some volatility without losing total return. And so that's the first thing. And secondly, I would argue that what we have seen over the last 10 years is that central banks have a knee-jerk reaction that when it gets bad, they tend to step in. I think there is a risk this time, because central banks have got their bit between their teeth in inflation, that they step in a little more slowly. But I don't think there is a world that I can imagine where we start to see liquidity dry up in credit markets and the equity market get really bad, and BlackRock, Goldman Sachs, Morgan Stanley are running to the Fed and going, I cannot trade, where the Fed and the US government starts to realize pretty quickly that if that goes on for long, then companies start to default and you start to see 10% unemployment and policy changes quickly. And what the good thing is that while what that has changed on a 10-year view is the reaction time between economic data and market recovery has got much shorter. Because, for example, 2008, we saw a year of market pain while central banks worked out what they needed to do. These days, the plumbing's there, they do it more quickly. So it tends to mean that the economic pain becomes realized, asset recovery starts, but we should still, but people in the real economy continue to have a hard time. So I do think that you can see a period of when we know that the Fed has paused, when we know that central banks are waking up to bad economic data, that we start to see that recovery happen, even though the picture for the man and woman on the street remains bleak for some time. The last thing I would say is that over the longer term, we have seen a big repricing of risk. When we start to see recession becoming the issue, and we go back to a world where the primary driver of market performance is where is growth rather than where is central banking, and obviously that will always remain important, then you should start to see fixed income correlations going back to normal. And we certainly believe that once you get through this period, that people will start to view safe haven assets as safe haven assets again, which I think would be a welcome relief to all of us. I hope that wasn't too long. I tend once too long as you.
No, very much so. We have actually had just a question in with a bit more UK focus on rates, just to sort of elaborate on the point a little bit. I don't know if you're into sort of rate predictions and things, but they're asking sort of maybe how much higher is anticipated for UK rates from the Bank of England, and where do you think that sort of terminal point might be? Given the inflation forecast might be starting to look, like it might be tipping off a little bit.
Yeah, I mean, one of our colleagues was saying in a team meeting this week that we're all, as I've sort of kind of said to you, basically we are positioned for central banks to have to pivot globally. Because the recession data gets so bad and inflation starts to fall. Now, when that happens, I said we don't know. The US, it really depends on how quickly the data moves and how the Fed's reaction functions. But one of my colleagues said this week that, in his view, the pivot has happened in the UK, and you saw that in the comments of Andrew Bailey that inflation is coming down. We can't tolerate much higher rates. I think it's very interesting that they're still trying to sell their bonds, but that's perhaps a conversation for later. But my view is that the interest rates cannot go much higher in the UK and are likely to start to fall more quickly than elsewhere because the economic situation is so much bleaker, thanks to a load of structural headwinds that the UK is facing. We have a growth issue, we have a productivity issue, we have the same post-COVID issues that most of the rest of the world does, but we're also dealing with a Brexit transition that makes it all the harder. This is not, I'm not getting into pro or anti-Brexit, but we all, we all knew that there would be a period of adjustment, and to have to do that period of adjustment, which will take several years, if not decades, right now is making the UK growth situation look particularly bleak. And don't forget that the UK is one of the markets in the world with a shorter mortgage duration. You know, all of the stuff that we all grew up with 2 to 5 year mortgages, if you're 5-year fixed, lucky, but many aren't. That's not actually particularly common. Australia is quite similar. One of the reasons why we like Australian duration. But you know, in the US and in Europe, your typical mortgage duration is 30 years. So people aren't having to reset their mortgages, you know, which means that housing has a big impact on growth, but it doesn't have the same impact on consumer spending. And that's one of the reasons why the UK can't tolerate much higher interest rates. What we will potentially see is inflation lasting a little longer in the UK, perversely, than elsewhere, just because we have structurally higher import inflation. But that will just add to the pain for the UK. I don't think we can see too many more interest rates in the UK going forward.
Okay, because that's I think is it fair to say the market was probably pricing another reasonable hike in December, and then potentially sort of and then some more incremental early hikes sort of at early next year. So you think that might be potentially a little bit overdone?
Well, my comments were directed to the UK. I mean, in the US, we have what's priced is another 100 basis points of rate cuts between now and rate hikes between now and March. And then the pricing starts to indicate that they really start to cut again next summer. I mean, it's interesting that historically, on average, the Fed starts to cut about 4 months after its last hike, which tells you that the Fed always overdoes it. Look, we don't bet on that kind of short term. What we think is that the Fed will either do those right now the Fed has already hiked too much. If it throws another hike 100 basis points on, that will mean to market volatility, a deeper recession, but ultimately it will lead to a bigger fall in yields to compensate for that damage. If the Fed wakes up tomorrow and goes, oh dear, we've overdone this, then performance from fixed income will recover more quickly, but yields probably don't have to go down quite so low to compensate afterwards.
Sure. We've got another UK sort of focus question. It's a pretty topical one, given the statement we'll be listening to in a couple of hours' time from the Chancellor. Is whether you see any impact on markets for the planned spending cuts and the tax rises that are coming, sort of obviously with a more UK focus hat on.
Yeah, I mean, I think that you have to be very careful in investing. In one level, it's hard to differentiate the UK from the global economy. So I don't really want to single out the UK. I think that anything that is particularly, any company right now that is consumer facing, cyclical, with lots of leverage, I would not have in a portfolio. And I think that's just all the more true in the UK. I think that the UK is going to see a very difficult period of lower spending, lower consumption, and lower growth, all at a time where its external investment is being made less attractive by political uncertainty and by a Brexit transition. So, ultimately, I think one of the problems is that what chancellors can do about it is pretty limited, because there is clearly a consensus that was shown by the reaction to the Truss Kwarteng budget that fiscal looseness for growth is not going to fly. That is something that incidentally is actually pretty bullish for bonds, because it's taught every chancellor or every finance minister in every country in the world a lesson that loose fiscal policy is something that's not going to be tolerated. The bond vigilantes are back, which is bullish for sovereign debt, we think. But the long-term fiscal issues that the UK faces, with the demographic position, with the fact that over the next 10 and 20 years, what we spend today on healthcare and pensions is just going up exponentially, it really is fiddling in the wind a little bit what chancellors can do in the short term, particularly because they're committed to not having lots of tax breaks and spending increases. So we just see lower GDP going forward, and it makes the UK a difficult place to invest. Where we like in the UK, though, is stuff that's, there are some things that the one benefit the UK has as a fixed income investor, that it's not very well covered in places like the US. They see it as sort of too small to bother about. When you look at, for example, the UK pub companies with debts secured on the land they own, they still look like pretty good investments to us, but you have to be incredibly selective. Sorry, it was a bit of a long-winded answer.
No. Well, and actually the selective point is a good one, I think. I mean, we hold in our portfolios, we hold the Jupiter Strategic Bond Fund, have done for a very long time as a core holding. We also have recently added the Absolute Return Strategic Fund as well. And what we like about the Jupiter strategies is the active management approach and the flexible approach of them. And we think, our view is that that's really key to navigate these sort of changing times. I mean, do you have a comment on that at all?
Yeah, I think you have to think very carefully about what you want from your portfolio and your investments and what your own time horizon is, right? We're lucky to have two fantastic teams. Without going into the detail, my role as head of fixed income, both Ariel, who runs the strategic bond strategy and has done since we launched it in 2008, and Mark Nash, who runs the absolute return strategy, both report to me, but they're completely independent in as long as they are fulfilling all the regulatory responsibilities that I'm on the hook for. As long as they're doing that, I'm very happy for them to take their own macro views. And the key thing I would say is there's a big difference in time horizon. So most of the kind of core views I've been representing are the long-term views of Ariel. And as I said earlier, his macro views tend to be 12 to 36 months out. And he's had a very fantastic track record over the last 14 years of making money from structural shifts. So when we see the pivot come in, when we, for example, July is a great example. He had the best performing fund, in the sector when rates and credit spreads move positively. That's something that he's positioned to perform when you see that big structural move with lower rates, and that should give, if you just take the current yield, which is 9% on that strategy for an investment grade rating, when you see that pivot in fixed income, he will perform very, very strongly because you add a 7 or 8 year duration. It means you make 8% for every 1% move in interest rates, plus a 9% carry. You can pretty quickly see that the returns on offer are very strong. On the other hand, the Strategic Absolute Return Bond Fund, that is a team that is looking across fixed income, but on a much shorter time horizon. So they are thinking right now, what happens in between now and year end? They've been short duration most of this year, thinking rates are rising, and they've performed incredibly well this year. Now they're pretty much neutral because there's risk that yields start to come back in again. That is a strategy that if you're looking for something that can guide you through the volatility on a month-by-month basis, it's done fantastically this year. If you're looking for something that can capture the massive return in opportunity in fixed income, then a slow moving kind of higher beta, as we say, strategy like Ariel's is likely to outperform over the longer term. That's how I think about it. It's a time horizon difference, but both of them have a role in portfolios depending on what you're looking for, and your own time horizons and your own risk needs.
But would you concur that sort of managing that fixed income exposure, indeed managing that equity exposure in an active way, is going to be sort of paramount sort of over the next 12 to 36 months as markets shift?
Yeah, I mean, I would say you this year has shown the benefit of being, for example, that Strategic Return Bond Fund has been short duration through some of it and has delivered a significant positive return for clients, right? It has the ability to do that, whereas the Strategic Bond Fund doesn't. The one thing I would really point to is if you're going through a recession, it's really difficult to sell all your exposure and buy it back again. Many people have tried. There's a few people who got lucky and made their reputations. Or made great judgment, whichever way you want to. But trying to time markets is a very, very difficult game. And if you can today, for example, in high yield, we think we're offering a yield to clients in strategic bond of 9%. The big question is default rates are going to go up. Investment banks are predicting they go up from pretty much nothing at the moment to 10%. In fixed income, if you get a default, you lose. You can lose years worth of returns. So the idea that you would buy passive credit right now strikes me as something very risky. And if you can invest in credit with an active approach and really pick the bonds that you own and know what you own and avoid those defaults, then even now the returns on offer are pretty exciting. Yeah.
I appreciate we're drawing towards the end of our time. I've just got one more question. Well, let me just check what it says. Yeah, so actually this is sort of one that's been tying into a lot of things we've talked about over the course of the year. Is how does if at all, how does sustainability factor into your investment process at Jupiter?
Yeah, I mean, look, the great benefit of being active managers, particularly on the credit side, is that we know every issue we invested with, we meet them, we do the modeling, and that includes the ESG. And there's different ways of doing that. You know, strategic bonds have been running for 2008, got a lot of credit. We fully integrate ESG, but we see it very much as, you know, what are the ESG risk from whether it's reputation, whether it's being, you know, becoming less profitable as you by not adjusting to climate change, whether it's investors turning away from you because you're polluting, all that stuff. Those are just key investment risks, right? Every time we talk through a company, we are talking about ESG risks. We don't always call them ESG risks, but that's what they are. We also have a strategy called Jupiter Dynamic Bond ESG, which is it is an offshore fund, it's a Euro fund, it's a CCAV, that is an ESG version of the strategic bond range that is available. We launched that to really react to the European ESG regulations. The FCA is about to come out with some UK ones, but that is an option for clients who want the same stuff. But there we have a much harder line on ESG. So we only invest in in companies where they have committed over time to make that transition to net zero, and they have a very, very clean bill of health when it comes to ESG stuff. In the existing strategies, we accommodate for ESG risk, and we will often make a decision not to invest in companies because ESG risks are higher, but we can invest in them. In the ESG fund, it's a real clear ESG risk, which you look up that strategy if it's of interest.
Excellent. Well, thanks, Matthew. It's been very, very interesting. I think to summarize, I mean, I think certainly there are still significant challenges ahead for the global economy. I think positively for everyone, there's some positive signs. Inflation is now cresting off. Obviously, that comes in the face of sort of more a bigger slowdown in growth. But I think again, from a positive note, there are some good opportunities there in fixed income, which do form still a core part of clients' portfolios. And I think with an active approach, not only to the fund management side, but also the asset allocation within portfolios. Certainly here at SG Wealth, I mean, we've been increasing our exposure to fixed income. I think there's opportunities there to sort of navigate the choppy waters that sort of lie ahead. So thanks for very much sort of putting some more meat on the bone on those points. Just a couple of things for the audience. We would be very grateful if you could complete your feedback questionnaires that will come out after the webinar. If you've got any specific questions at all, please do feed them back to your advisors as normal. We will be having our next update call early in the new year. We'll look back at 2022 as a year as a whole across all asset classes. I know we've been quite fixed income focused here, so we'll be looking at equities, looking at bonds and real assets and all the other asset classes that make up the portfolios, and also looking ahead to the year and future years to come. Just one other thing to mention. Obviously, we do have the autumn statement coming up in just under a couple of hours' time. We will be expecting some changes to fiscal and tax policy. There may be some effects, therefore, on people's personal finance situations that may need some adjustments and tweaks. We'll be sending out our guide to that either tomorrow or Monday, so look out for that in your inboxes. And of course, again, if there are any changes to tax that do require any action, advisors will be in touch with you thereafter to discuss sort of your own personal positions. So that's it from me. Before I go, I'd just like to thank you again, Matthew, for your time.
Thank you.
Thanks to everyone for joining us on the call, and I hope you all enjoy the rest of your day.
All the best.
Many thanks.